Hello and welcome to Jim Dalton's presentation, Trading in High Volatility. It's February 25th, 2016, currently 12:03 p.m. Eastern. We apologize for being late. My computer decided to shut down about 5 minutes before. So thank you for your patience, everyone. Great to see all of you. Thank you for coming out. We will go for about an hour or maybe a little longer, depending on how many questions we have. But Jim and I want to thank you for being here. So with that, I will turn it over to Jim. Hi, Jim.
Hi, thank you. I have a question. What are the chances that we're going to be able to do the replay?
I'm working on it right now. Hopefully not a
Okay.
problem. Just ask me.
Okay.
I'm going to work on that right now. Thanks.
Okay. Thanks. All right. Trading in high volatility. Obviously, a different environment than a trending market. Put a little perspective. I was surprised the other day. I heard someone talking and saying that the 20-year average for VIX is about 20%, and at that day we were at 19%. But we had low volatility for so long, at one point getting under 10, that I think we forgot what the average volatility was. So now, from a trading standpoint, we're trying to adjust for something that we haven't seen in some period of time. Not at least in the S&Ps. It still has existed in the grain markets, etc. Volatility is very often a sign of uncertainty. When markets are uncertain, they tend to be very susceptible to perceived clues as to the next auction direction. And what I'm trying to get at there is that when you have a trending market, they're more readable, they're more logical, and they're less emotional. That doesn't mean that they're devoid of emotion, but they're less emotional. When volatility is high and uncertainty exists, traders will look at anything to a clue, whether it be bonds or whether it be the dollar index or whether it be, as we're seeing right now, crude oil, and they will go off and running and think they have seen or discovered a pattern, and away they go. And it works for a period of time, and then they go on to something different. So, and this makes it difficult. It isn't difficult when traders act this way. When you understand what is going on and you understand what references they are looking at, and then you understand when those references are or are not working. But that's pretty much the pattern that we've seen lately, and of course there's been a lot of dependence on crude oil. You know, one time I read somebody said it was the highest correlation in 26 years. The other day I heard somebody else come on and say that the correlation was 58%. And obviously we see that go back and forth. The more uncertain the market is, the more likely traders are to pile on to momentum. That momentum is often triggered by short covering or long liquidation. And that is absolutely something we have experienced lately. You'll get a market that starts off as a short covering market, and short covering kicks the market into high gear, and then the price-based systems kick in, and then the momentum traders jump on, and we take these things to very visible, and I'll talk more about that in a minute, very visible levels, and those we can reach those levels fairly quickly. For example, we came off the 1800 low, and in 7 trading days, the market went up 140 handles up to the top of the trading range, which was just slightly above 1940, and we're going to look at that a little bit later. But again, that's what happens. It's this, something gets started, and then when there's nothing else, people pile on. And if you understand that, it's very tradable. If you also understand that they're liable to take the market to the opposite extreme, from too short to too long, or from too long to too short, And we're going to see in just a few minutes, we're going to see one of those examples of going from too long to too short. And if you don't understand it, it can really hurt you. If you understand what's going on, it can be very, very profitable from a trading standpoint. And we're going to go back and we're going to take a look at what happened yesterday in just a few minutes. Tuesday's night report for Wednesday, February 4th, for yesterday, read as follows. Wednesday, the odds of downside continuation on Wednesday are greatly lowered because Tuesday's break was on lower volume. Lower volume reduces the odds of immediate downside continuation. Now, it wasn't lower volume relative to the day before, but it was lower volume relative to what we have seen this year. In fact, Tuesday and Wednesday were among two of the days with the lowest volume of the year. So we had Wednesday, and we had Monday was a balanced day. We then broke to the downside on Tuesday, but then we're saying the break was on lower volume, and lower volume reduces the odds of downside continuation. This was also written up. This is a report. When we put out a report every night. We put out what's called the daily research and preparation report for the following day, and we do that for all the people that are in the intensive. So what I'm reading from is a report that was in people's hands prior to the opening on Wednesday. The last part of that report said Tuesday's very prominent POC did not migrate lower with afternoon prices. The potential is for inventory to have gotten too short. This may have to be corrected in the morning. If the market trades lower prior to some inventory adjustment, the odds quickly increase for a later, more aggressive rally. And of course, we certainly saw that yesterday. There's the break on Tuesday. Here is the point of control, and see how fat it's gotten up there. Tuesday's very prime point of control did not migrate lower with afternoon prices. So well, this is the market selling off. The point of control is way up here. The settle is down here at the 1915 level. The first thing that catches your eye, when the POC does not migrate lower proportionally with price, that is usually an indication that traders are getting short at poor prices or short in the hole. We also call this a 45-degree line for people that have been in the intensive and have traded with us previously. And the 45-degree line is just saying that this is the fairest price. If instead of thinking about this as the POC, think about it as the fairest price at which business is being conducted. If this is the fairest price and the market keeps trading lower in the afternoon, then there's a pretty good odds that traders are what we call getting caught short in the hole or selling at prices below value. Now, that doesn't always have to come back at them, but it certainly changes the odds for downside continuation. We're going to come back, we're going to see that a little bit more here in a minute, but the more uncertain a market is, it's a separate subject, but the more uncertain a market is, the more likely auctions will respond to very visible destinations. The prior low for the current trading range, which ranges from about 1800 to about 1943, was at 1804.25. The market broke the low on the recent break was 1805. Very indicative of an uncertain market, and traders push markets to very visual levels. Now the market, as I said earlier, in 7 trading days went all the way to the top of the very visible high at 1943.25, and this high was 1943.75. And 7 days. So again, it's just another indication of markets that lack longer-term participation and are made up far more predominantly with traders, short-term traders. Now, that's day traders, it's short-term traders, and short-term traders, as we define them, are a very, very powerful group. They're traders that will be in the market 3 to 5 days, sometimes up to 9 or 10 days. They have many different strategies. They have very large pools of capital, in some cases billions of dollars, and that capital is also leveraged. But it's very aggressive trading capital. But it's not investment capital. This is indication right here that when it's up, and by investment capital or institutional capital, I mean money that is more likely to buy and hold, or be in or out of the market for extended periods of time. These short-term traders are very aggressive, and they will press markets. Once they see something moving, they will press markets and taking it to these very visual levels. High volatility markets are, like I said, more often associated with trading environments. Trending markets are more often associated with lower volatility. And when you get a trend, it's easier to trade with a trend. If the trend is up, there'll be corrections to that trend, but at least you'll have some idea that there is a direction to the market. And if you get involved in a counter auction to that, at least you'll have a better idea of what you were involved in. And it's very, it's very likely to get counter auctions. But we went when the S&Ps were trending higher, we went 6 and 7 months in a row sometime with the market one time framing on a monthly basis higher, meaning that the low of the next period of the next month did not take out the low of the previous month. So that was a very tradable market within a trending environment. Higher volatility environments are much tougher markets to trade, and I'm going to say unless, and this is, in a way, it's a commercial, unless you really do understand market-generated information. Market-generated information is ideally suited to this environment. Market-generated information is, we get, by looking at the markets, we get some idea of where traders are and what their positions are. Let's go back here for a second. This is market-generated information right here. When the point of control is up at the 1923.50 level and the market trades lower, that's market-generated information. A bar chart is going to show you one dimension. When we look at a profile, we get two dimensions. We get price and we get time. If you extrapolate and say price times time equals volume, then you get a three-dimensional view of the market. So it's a much more in-depth view. As somebody sent us, one of the people that's in the current intensive sent us a piece on art the other day. And in his connection was, when he looked at the profile, that the profile, like art, stimulates a greater portion of the brain. It involves a lot more of the brain in the whole process to understand what is transpiring in the market. Okay, I want to go, we're going to open this up for questions in a minute, but I want to go back, and before we do this next thing, I'm going to go back. I'm going to take a look at the current market and give you an update. We talked earlier, you saw what we wrote on Tuesday for Wednesday. So here is yesterday's market, and you see the short covering rally late in the day. So if you remember, what we wrote, the point of control on Tuesday got the market very short, in our opinion. Then we wrote that if the market didn't correct this inventory first, but yet opened lower the following day, then the odds were high for a much more aggressive rally later. Now, we're not talking, what you saw written there isn't something that was cherry-picked or written after the fact. It was all written before yesterday happened. And then the market really took off, so they got the shorts from overnight and the shorts from Tuesday, and you had a huge short covering rally yesterday. Additionally, and it won't show on here, I'm going to split this out for a second. One of the things that we said was in these type of markets that are very trading oriented and with all this uncertainty, markets tend to go to very visual levels. Now, the first visual level we showed you was the high and low of 140 handle trading range. All of the things we talk about are equally applicable to the shortest of time frames. If you will look at the F period high that I just marked at 1908 level, 1908.25. Let's go back and look at yesterday's rally. The market put in a low in C period. Then it began to one time frame higher. One time framing means that the prior period did not take out the low of the next period, did not take the low of the prior period by more than a single tick. So D period is one time framing, E period is one time framing higher. Then you get a big run in E and F period. Still one time framing. The F period high at 208.25, which I marked, at that point in time that was made, that was halfway back relative to the overnight market. So it was exactly halfway back relative to the overnight market. The market then broke and stopped one time framing. During a trend day, it is very common for a trend day, a good trend day, to only stop one time framing in one period, which then allows inventory to come back into balance. When this happened yesterday, we put out a caution, and I'll show you a couple chat comments. We have, for people that are in the intensive, we do the 2 reports, and we do several live webinars, but I also put out chats throughout the day. One of the chats that went out yesterday highlighted the 208 F period high at exactly half back relative to the overnight. Now, we don't tell you where to buy, where to sell. We try and give you the background, so an understanding so you can make your own decisions. When a market goes to a very visual reference and backs off, that is not normally a lasting reference. It's what we call a weak reference, and we define a weak reference as something that went exactly to, or just a tick or two shy of a very visual reference. So when this market backed off yesterday, and I put the chat out, what I was looking at that point, this looked to me to be an opportunity to get into the market. This is your pullback. So if you get a trend day, what you're trying to do is, people always say, well, once I got a trend day, how do I get on board? How do I get on board? you're looking for a pullback. Now, we don't know if this, if it's going to pull back. It may go straight on down, but you got the pullback, and then the market started to trade higher. It then one time framed higher through the remainder of the day. So it was a classical trend day, and it did trade higher throughout the remainder of the day. Now, before we go into, I'm going to collapse this. Before we go into today and some comments I want to show you from this morning, when you get a market strung out like this with multiple distributions, these are anomalies that kind of stick out like a sore thumb, more multiple distributions, and on top of it, this was on low volume, you have to think that you have to know that from my observation, there's pretty good odds that we're going to see that day retraced. It is normally not retraced on day one. For it to be retraced on day one would be unusual. More than likely on day one, when you have a reversal such as you had yesterday, the market will move sideways. Now, the report we put out last night, and this is kind of how we look at markets, we're looking to see, is there change relative to late yesterday afternoon. We had marked this this is the upper distribution from yesterday, and we treat each distribution, just as distribution 1, distribution 2, distribution 3, we treat each distribution as a separate auction. So our comments in last night's report were that any meaningful change relative to yesterday will find acceptance this morning down below the upper distribution. You can pick a couple of prices for that upper distribution. If I take the maximum, this would close that distribution, take out the single prints. The low of that distribution would be 1920.75. The overnight low was just at that level. There was no price acceptance below that because there was no double prints. The early morning low did not take out the overnight low, and we'll see again at that point I put a chat out, and chat read, if there is no downside follow through or the ability to take out the overnight low, then the odds are that the market will begin to rotate higher, which is exactly what happened. So this is what we're talking about here. This is market generated information. We're not profile traders. We use the profile to organize the market's continuous two-way auction process. But by organizing the data, organizing the market's continuous two-way auction process under the market profile, we get a better opportunity to interpret the data released from what traders were doing previously or what they're doing right now. Okay, so now, before I show you the next thing, we talked about weak highs or weak references. So before we do that, we're going to mark yesterday's high, which is at 1937. I forget exactly what the 1937.25. We have an overnight high at 1938.50. Now, this morning, if you look at the early morning, the market opened where you see the green dot. The market opened where you see the green dot. The lowest it went, I believe, early on was a single tick above unchanged. The green line here is a single tick above unchanged. So this was the initial opening. The low was a single tick above unchanged. The market then rallied up to the A period high. Now what I want to show you, at 9:30, let me make this, this is to give you some idea of what we do in the intensives, we're trying to help you interpret and understand what is going on in the current market. And sometimes it's what are the odds for going forward. But this morning, the chat, 9:36 a.m. Eastern Time, which was just 6 minutes after the market opened, said the low is questionable, being just about at yesterday's high and unchanged or settle. 9:38, 2 minutes later, 1929.50 has been the pullback low for the last couple of hours, meaning half back from the overnight market. Now keep in mind, when this went out, when the 9:36 chat went out, the market was trading up near the early morning highs, or near yesterday's high, just a couple ticks below yesterday's high, which incidentally also makes that a relatively weak high because it's only 2 ticks away. But following that chat, and the real thing I was focused on was that the low here was very suspicious because it was the opening, early morning opening was just about at yesterday's high. The low was just a tick above unchanged, and that was very suspicious to me because what happens, here's the thing you're trying to think about. Who buys the market at exactly unchanged or exactly at the previous day's high? Generally speaking, that's very short-term trading money. The shorter term the trading money is, the lower the odds that that is going to be sustainable money. These are the people, these are the traders that tend to change their minds very, very quickly. So this is what happened this morning. We did come back quickly back through that. You saw a period extended to the downside. This was the other comment. I said 1929.50 had been the pullback low prior to the market, the last couple hours prior to the market opening. Also, the white line here represents the half back from overnight, another weak reference. So that information was very helpful. As you see, the market did extend, A and B did extend down to the bottom of the overnight range. So again, what I've tried to highlight in here before, and then we'll open this up for, I'm sure, substantial questions. What I've tried to highlight is that in volatile markets, there is more of a tendency for the markets to exist in a trading environment, a very volatile trading environment. Traders are unsure of themselves, so they tend to do the easy thing. They go to very visual references. Traders don't know what else to do, so if you get a little momentum going, people that are not normally momentum traders will pile on. A lot of times, those trades begin with short covering or long liquidation. Yesterday's market fits what we're talking about, and these slides were made up, I've done this before. These slides were made up, for the presentation, but we've talked about this multiple times. The market got short we saw what we talked about earlier, and then the traders jumped on, piled on, and they take the market substantially higher all day. So when we do the intensives, and we've got the next one coming up here, I think it starts in April, when we do those, what we're trying to do is show you how to read and interpret market-generated information, how to have, we break it down into 2 psychology sections. One, self-understanding, and the second is understanding those that you are competing against. And what we've just talked about now focuses heavily on what is the expectations for those that you are competing against. Before we open the questions, what we're doing, we are in between two intensives right now. In between the intensives, the whole program is called the legacy, or the, I just draw a blank, continuation, because what we're trying to do is keep you in touch. So people that enjoy, that engage with us now for the final intensive, we will continue to do 2 reports a day, and you saw examples of some of that earlier. So we'll do the daily preparation report, recap and preparation report, and then we update the report in the morning after we see what has happened overnight. Additionally, I will make some limited chat sessions, comments throughout the day, and I'll let you see what that looks like. Okay, so this is what you see. There's one of the early comments. 1929.50 has been the pullback low for the past couple of hours, half back from overnight. So those are the comments that we see go out in the mornings, and I'll do a couple of those each day to kind of help you stay in touch with the market. If you haven't been in a prior intensive, then what happens is this prepares you for the intensive that starts in early April. If you have been in the first intensive, this gives you continuity to go from the first intensive to the second intensive. The people that have been successful, that have been with us in the past, say a lot. They say you can't hear this information enough. And one of the things, we were reading a book the other day called Ignorance. It's by the guy, he's head of the neuroscience department at Columbia. And he made a comment about, he said a lot of times hearing something multiple times is very helpful, because some people just, it doesn't hit them, say one way, but said multiple ways, all of a sudden it will register. But he also had another comment, and that is, a lot of times people will say, well, I took a prior intensive, I've heard these before, I know that. And he addressed that. He said, what happens? People have a tendency to say things like that because they do think they know it. But he said, every time you hear it again, it adds texture to what is going on. And one of our favorite sayings is, everything is a series of facts surrounded by other circumstances. And it's very rare that anything takes place in the market with exactly the same circumstances as you have seen before. All right, I've talked for too long, but I wanted to give you an idea. Julia, let's open this up for questions, please.
Okay, thanks, Jim. Question from Jeff here. So is Jim saying the shorter term, short inventory trumped yesterday's gap rules? How does one adjust from looking to go with developing value lower to jumping on the trend higher?
Okay, well, number one, the gap rules did work yesterday because they did. Well, they didn't. The gap rules. We didn't get higher value because of the distance, but remember that if you take the gap says go with all gaps that aren't filled fairly quickly. But remember, we just talked about the importance of everything's a series of facts surrounded by other circumstances. So the circumstances were that the gap was lower, that the market gapped lower yesterday. But remember what we wrote on Tuesday night. Tuesday's break looked like the market was already short. And we also wrote on that day, if the market opened lower the next day without correcting the Tuesday inventory first, the chances for a much more aggressive later rally were high. So that was already covered. But too many times that people they just want to take a single rule, and things don't work over a single rule. And I mean, they're good, they're guidelines, but the other circumstances which were outlined ahead of time overrode everything else yesterday. So you got the low early, and as I say, all but one period, the market one time framed higher throughout the day. Okay, but that's a good question because it really brings it back to the importance that it's not as simple as a rule. You always have to, every rule has to be framed within what are the surrounding circumstances. Okay, another question, please.
Is halfback more significant than the daytime frame halfback? Or as significant?
You're talking about overnight halfback. What you'll find in trading environments, we said that traders go to things that are very visible. Halfbacks are very visible, whether it's overnight or whether it's during the day time frame. So I use both, and they'll be used in two different ways. For example, if a market like yesterday that rallied to halfback in the 6th time period, one trader, and I know we have a prop trader that does it very well, one trader will use that to short immediately. I don't short immediately. I'm looking to buy a pullback. So the same reference, two traders using it entirely in an entire different context because they're different traders. They look at it totally differently. So again, but your question, halfback, I find it is relevant in all markets. It's a weak reference. It's like I talked about this morning. I watched this market come down a couple hours prior to the opening. You could see traders mechanically buying it right at halfback, taking the market up, halfback, taking it up. They were getting inventory longer and longer and longer. These are weaker traders that buy that exact. Then you saw that we got the liquidation following the opening and fairly quickly following the opening. So it kind of, they were weaker hands traders. We washed those traders out of the equation. Additional questions, please.
Yes, and Brad, who just asked that question, he had asked a halfback on a 24-hour chart. And Jim doesn't, if you want to comment about that, Jim, you will split out your profiles at all times.
I do not use 24-hour charts. It may work for some people, but I have found that you have one market in the U.S., you have another market in Asia, you have another market in Europe. I do use the combined halfback for overnight, but I do not use it on the 24-hour basis. I'm sure sometimes it'll work. Almost everything will work sometime. I just find that using the 24-hour profile many times will leave out some of the detail that I think is significant, particularly when I begin to trade in the daytime frame. Additional questions?
Yes, thanks, Jim. Just had it. Give me a second, Malcolm, here. I saw it early today that it was a rotational day, and I've been on the lookout for trades, but with the narrow price movement, and now we're 6 wide, I've been sitting on my hands. Oh, thanks to the intensive. Okay. But do you have any comment about the trading range we're seeing here, Jim?
Well, let me go back. Let me cover the whole thing a little broader because it's a great question. There's all kind of information involved in this. First of all, I did see a trade this morning. I saw two trades. I saw the trade at the high, and that's why we put the chat out. And then there was another chat when the market didn't take out the overnight low. I said, then the odds are pretty good that we rotate higher. So I saw a trade from the high, and I saw a trade from the low to rotate back higher this morning. So I did see two trades. Those are fairly early in the day. The next thing that we teach is, and there's another chat, it's that sometimes you have to have the patience just to sit on your hands and not do anything. And I think that after it started to get wide in here, that's exactly what you should be doing. There are the three biggest reasons that traders fail are they overtrade overall, stops are too tight, and they get stopped out of good trades. When they do it, they put a stop in thinking that they're being prudent by having the stop very tight, when in fact they're doing just the opposite because you get nickel and dime, and over a period of time that adds up. And secondly, trading too quick off the opening. Now, that may seem like difference from what I said this morning, because this trade took place just a few minutes after the opening. A lot of people traded at the opening, and I was trading a few minutes after the opening, but I'm looking for a reference, and I'm looking for a reason. So the context gave me, I wasn't trading right off the opening, I was trading following the opening. But so again, too many times there's people are too anxious to trade early on. Oh my God, if I don't do this, I'm going to miss the best trade of the day, So sometimes it's very good to sit on your hands, and it did give us an opportunity up here. The last thing I'll say, it's a great thing about this being narrow in here. The other thing that we talk about, and this falls into the category of people over trading, is people will sit down there and they'll look for trades. Now, what I'm saying is, and sometimes people don't grasp this point. If you have a good understanding of the market, you don't have to look for trades. The trade will appear. This trade appeared. This trade appeared. And if you have patience, the trade will come to you. Too many times, people are staring at the market, desperately looking to find a trade. The harder you look to find a trade, the lower the odds it's going to be a good trade, the greater the odds that you're going to overtrade and you're going to get yourself chopped up throughout the day. Okay, so that one question brought a lot of comment, but it really brings home a lot of very important information. Okay, what else have we got?
Okay, is Jim seeing the B period low as weak since it was only a tick away from M period yesterday?
No, I don't see it as weak.
Came into the single trend.
I was looking more at what I was looking more is at the overnight low. I was looking more at the overnight low rather than I was trying to be exact to this. One of the things I say often too is exactness kills. And you just got to be cautious. I mean, sometimes exactness tells me it's a weak reference. I didn't see this as exact. I saw the morning high more suspicious because it's only a couple of ticks below yesterday's high. I saw this as more questionable than the low. But overall, this is a very narrow range. And before this day is over, it's not impossible that we get a meaningful breakout from this narrow range. It may just balance like this all day. But the range or the base is very narrow. It's like a lamp. It's very easily tipped over. If you do get a breakout from this narrow range, for it to be any good, I would think it would be a double distribution day. In other words, the next distribution would be separated by single prints. Okay, other questions?
Jim, while we're here, you see how you have two profiles open for today? We didn't have time to fix it. Could you don't have to down click on anything, just hover over each time template. There it is. You see that? So drop that one down right there and shut it off because it's a little confusing. And then you can shut your time templates.
Okay, I'm sorry. The first one didn't populate fast enough, and okay. All right, other questions?
What characteristics help you identify that it's going to be a trend day?
Okay. First of all, the circumstances. Remember, we talked about the circumstances. And, so many times what happened before has a lot to do with the outcome going forward. and I don't mean to beat it to death, but you did see what was written Tuesday night for Wednesday morning. And what was written is that it was already short from Tuesday, and we said if we opened lower without correcting that inventory first, we could set ourselves up for a more aggressive rally later. And that's exactly what we got. So the circumstances are the first thing that give me some idea of what can happen. The next thing is very often the kind of confidence associated around the opening. So you have a couple different kinds of trend days. You have a straight trend day, which is, the market just moves directionally most of the day, usually one period that it doesn't, it adjusts inventory. Then you have another, which is a double distribution trend day. A double distribution trend day will normally have two distributions, and that one of the characteristics then would be that the range for that distribution is relatively narrow. Later in the day, that gets blown away either on the downside or the upside, and so you get a double distribution trend day. But for the normal trend day, it's the circumstances leading up to it, and that's where yesterday came in. There's the open. I'm going to split yesterday out for a second. Okay, so the market opened and it drove lower immediately. So I said, oh wow, that's pretty high confidence immediately. Yes, it was, and it went back and it filled the gap that was left from last Friday. And incidentally, before we go any further, just while we're here, we had written that this gap, when this gap attempted to be filled last Friday, we said this was a poor low. We also said that because this was a large gap, that the odds are low that a gap of this magnitude gets filled the first time. And it didn't. It was a couple days later before it got filled. So there's all, when we're talking about doing these intensives, it's easy to teach people the basics. But what really makes the difference and makes you a really good trader, professional trader, understanding the nuances. Understanding the nuances, understanding the people you're competing against. So while we're here, that's a nuance, but it was taken out yesterday. So now, back to your question about a trend day. Okay, so early on, it really, trades lower very quickly. And that's not to be too surprising, because everybody's, oh boy, this market's really weak. Plus, markets are very visual. The very visual level as the market opened yesterday morning would be to trade down to the 1892 level and close the gap. But it's easy to see. Everybody knows where the gaps are. They can see it. So this is what we call a destination trade. It's visible. It's easy to see. Market opens, and boy, everybody knows it's weak, and away they go to get to that destination. They got the destination, and then, they get very little follow-through. B period. They go up with C period. They come down again. So you can see everybody thinks this market's really, really weak, and they don't understand how the condition of the market coming into today. So they're selling every little rally yesterday. They're selling the A period. They're selling the little B period rally. They're selling the C period. They're selling D period rally. They're selling. We talk about understanding the psychology of the people you're trading against, competing against. The market was already short, and now every time this market rallies yesterday, after it closes the gap, short-term traders can't wait to sell it. A daytime frame and short-term, they can't wait to sell it. Oh boy, I'm going to sell every rally, sell every rally. They're just getting themselves deeper and deeper in trouble. So now, again, it's a long explanation to a trend day, but each one is different. Now they've got the market just unbelievably short. So it was short from the previous day, short from overnight, and then for 2 hours, they're getting it even shorter yesterday, selling every small rally. So they got the market short. Now you have an excess low. That excess low is not taken out. Then the market starts to one time frame higher. Now, here's a question that I'm going to pretend somebody asked me this question. Let's say somebody said, okay, Jim, Julia, well, how do you get on this trend day? I mean, this feels pretty heavy. Here's a beautiful example. In D period was an inside bar. The two most important concepts we deal with as we go through the intensive are excess and balance. Excess marks the end of one auction and the start of a new auction. Balance brings, when you come out of balance, three things happen. Either you stay within balance, and with the range, this is unlikely it's going to be there. You come out of balance, you either come out of balance and fail, or you come out of balance and accelerate. So this is what we have a sheet we call signature trades. When this market comes out of balance, out of D periods, an inside bar, it's a form of balance, comes out of balance, that's where you get onto this trade. That's where you get on your trade. You came out of balance, and usually one or two things. You either come out of balance and accelerate, come out of balance and fail. Come out of balance and accelerate, and that's usually a pretty good indication of the market. Now, so that gets you on to the trend day. And then we said, usually one time, it will stop one time frame. It did that. This gives you, this takes your breath away for a while, but then at one time frame higher the remainder of the day. A couple other questions, please.
Yes, Jim, from Jim in Romania. Could today be a balanced day, thus ending the auction to the upside and setting up a retest of yesterday's poor structure and multiple distributions?
It is a balancing day so far. And from here, the market, I placed the odds that the market trades back lower after it balances. But remember, what we do each day is when we come in, we want to have at least 3 or 4 potential scenarios. So let's say that the market closed right here. Okay, then we would, for tomorrow, we would say balanced trading rules apply. Balanced trading rules remain within balance, very likely because the range is so narrow. Another scenario would be look above balance and fail. Then the destination trade becomes the opposite extreme, look above balance and accelerate. So that if this was a balanced day today, that would be a scenario. Another scenario would be, look below balance and fail. If that happened, then the destination trade would be up to the top of balance. Look below balance and accelerate lower. If that happened, then we come back to taking each of these distributions one day at a time. So the first would come down and close the single prints here. So again, it well could be a balancing day, setting up something bigger on the downside, which I think the odds are fairly decent, but that's only one scenario. We always have to be prepared for what doesn't happen. And let me go back for a second. I'm going to go back. We just got done saying that excess and balance are the two most important concepts that we deal with. Let me get this. Okay. The high that I mentioned up here before was 1943.25. The high from the other day is 1943.75. Only 2 ticks. So there's no meaningful excess on the high. So there's a good possibility that this auction is not completed to the upside. Now let's go down and look at the low. The low on the downside, 1804.25. This low is 1805. So there's only 3 ticks. So this large trading range, whoops, I just messed up. But anyhow, that large trading range has only 2 ticks of excess on the high and 2 ticks of excess on the low. Neither side of that trading range gives us any real comfort that either the upward auction or the downward auction has been completed. Again, as I said, when they go to these very mechanical levels, 2 ticks and 3 ticks, it's usually a sign of a trading environment. It's not a sign of more serious money. So anything could happen in this. I don't like the high. I don't like the low. we have a balanced day yesterday, today, at least that's what it looks like it's going to be. So I'm going to apply the balanced trading rules to today. Okay, sorry for the long-winded answer, but so many of these answers, they're not, if the answers were simple, it would all be set up on a computer or an algorithm, and you wouldn't have it prior. I think that being able to read market-generated information far surpasses anything they can set up on an algorithm. Okay, other questions?
On Wednesday, we did not have the POC migrate higher with price. What did you make of that day?
Okay. Anybody that's been around has heard me multiple times. Do not consider the POC on a trend day. People make that constant mistake. They fall in love with the POC, and on a trend day, you disregard the POC. It is irrelevant, and it will do nothing but get you into lots and lots of trouble. On a rotational day, the trend day is very important. On a rotational day, it's very important. For example, this day started trend, and it went rotational. So the fact that it started trend and went rotational, that means the POC was very important. Okay, good question, and it's something to focus on, because the people like certainty, and volume POCs and TPO POCs, I got that, and they can really distract you on a trend day. They're not relevant. Okay, other questions, please.
Do you see a correlation between gold and the S&Ps, or he's saying the SPX?
I do not, and I know I've seen people try and find that, and some days you'll see it, but no, I don't. I mean, if anything, recently there's been kind of a reverse correlation, as S&Ps have gone down and people get afraid, they go out and buy gold. But no, I have not seen that. Okay, other questions?
To follow up with a comment you made earlier in the presentation, Cam is asking investment capital, quote unquote, does not trade as so much in the ES futures. Would that be correct?
No, I don't. Investment capital is more often than not buying stocks. Okay. Investment capital, they buy stocks. However, where it comes in is if, in fact, something is changing in the market very rapidly. You will have some managers a little more sophisticated than others, and they will come in and buy the futures first in order to get represented in the market. When they do buy, they generally buy the ES because there's so much liquidity. And if you look at the volume alongside the ES, I mean, you can see this is pretty low today, but some days you'll see 40, 50,000 contracts. Okay? Other questions?
We traded above and now back into yesterday's range. Isn't that a signal that we might be headed to the low range of yesterday? Thanks, Jim, for that question.
I don't think we're going to the low range. It would be very unusual to, with a base like this and it's this wide, it'd be highly unusual to go to the base of yesterday. And again, sometimes we can look too hard. Right now, and I understand if somebody knows me, one of my favorite trades is, look above and come back into a previous day's range. But I think on today, I think there's more of a chance that we're having balance. Yesterday was a really, yesterday shocked a lot of people, caught a lot of people off guard. I believe, my overall belief is that the odds are better that we retrace yesterday over the next few days. Doesn't have to happen, but that's kind of what I wouldn't be a bit surprised. But I'm not going to throw out the possibility that we do go higher coming out of this balance. But I think the odds are better that we go back and revisit, correct a lot of these areas that were so strung out and with anomalies and multiple distributions. Okay. Now this H period, look at the H period low. Goes down to exactly half back. And somebody said it's half back from overnight, it's half back from the daytime frame. All we've got going on in here is short-term trading money today. I don't see anything other than very short-term trading money in this market. Okay, a
Okay,
couple more questions and then we'll wind it up.
a question from Jake. I think, Jake, you're referring to the trend day comment. So if you're not, please come back. Do you also disregard the value area?
Yes,
Okay, he is. Thanks.
because value areas are determined by the POC. The POC is the longest line closest to the center of the range. On a trend day, I am looking for direction, and I'm looking for confidence in that direction. Okay, but a good question. But focusing on and think about it this way. There are people, because they've heard me talk so much about value, because we trade value, not price. And price is just an advertising mechanism. But where people get messed up is they start looking at the POC and looking at value. But remember, in a trend day, price is leading value. So on a trend day, when price is leading value, what you want to see is how much confidence there is. And if you're continuing to one time frame, then your odds are really high that value is going to be pulled up to price. But price is going to lead value on a trend day. Okay. Couple more questions.
I'm struggling with the 80% rule. This is from Catherine. Would you please help me with recognizing those opportunities?
Okay, good question. When I first got involved with the market profile, I took courses from Peter Stottlemyre. And Peter Stottlemyre talked about the 80% rule. The 80% rule said that once you re-enter a value area from either above or below, the odds were 80% that you would trade all the way through that value area. When I first wrote Mind Over Markets, and how I got involved in this, I had been, and how I got involved with Stottlemyre, I had been working on distribution curves for some period of time. Somebody saw some charts on my desk one day and said, "Oh, do you know Pete Stottlemyre?" And I said, "No." And so they brought Pete up to meet me the next day. And he was doing something entirely different with distributions than I was doing. But in that process, I understood within seconds almost the fantastic discovery that Pete had made. He was a statistics major out of Stanford, I believe, and what he realized was that scientifically, in order to organize data, you need a constant and a variable. And what he hit upon was the idea that time could be a constant. So in half an hour between 8 and 8:30 is the same as between 8:30 and 9. So he then put time, the constant, on the horizontal level and price, the variable, on the vertical level. So anyhow, in that process, I understood immediately what he was doing. He was trying to publish a book at that time, and he said, "Did I want to sponsor his first book?" And within minutes, I wrote him out a check for $10,000 because I recognized the value of the observation he had made. So now I'm kind of a Stottlemyre groupie at this point. Then, as I got more and more involved with it, I know that one of the best ways to learn something is to write about it. So I wrote about the profile, but in that process, a lot of what I was taking was things that I had gotten from Pete, and I hadn't done this long enough to validate it myself. Well, as time went on and I started to test everything that I could, I came to the point that there were a couple things that I thought were not valid. The 80% rule was one of them, and I no longer use the 80% rule, haven't for some period of time, because I just didn't find that those odds really worked out that well. What I found was much better to see where value is developing relative to the previous day. That was far more relevant to me than that. And incidentally, the other thing, while I brought it up, the other thing that I no longer that I jettisoned very quickly. Early on, Pete used to talk about range extension trades. They used to define the first 2 hours of trading at the AB period as the initial balance, and then doing trades outside the initial balance. That's something I also do not. I got away from doing range extension trades fairly quickly, and I got away from mechanically saying the first 2 hours were the initial balance. They work that way today, but that's not very often. And I just found that was not beneficial. The other thing I found is doing a range extension trade, sometimes, if the circumstances were right, would put you long or short at almost the risk prices for the day. So there are, I forget how many, Julia knows how many years ago that was. I care to not think about it, but there's been some changes. Over the years. The 80% rule is one of them. The initial balance is another. I don't consider initial balance. I just look to see what naturally looks like the base of the market and how it's set up. And I don't mechanically do range extension trades, because if they don't work, you're in very bad trade location. Okay, couple more before we wind this up.
Yes, well, you had just touched on the initial balance, but Jeff had asked, is crude the only market with a 30-minute initial balance, or are there other markets like this? For instance, the gold pit starting at 7:20, he must be in Central Time. Also, is there a place on your website that provides TPO tick aggregation settings for different futures markets?
No, but again, I don't use initial balance. That's what I was just saying. I don't use it. I look and see what more naturally sets up with the market. So I get more naturally involved in the flow of the market. Okay, one more question and then I'll do a wrap-up.
Okay, do you think we are getting another perfectly balanced day like we had on February 22nd? If so, wouldn't it be rather odd to have 2 days like this, more or less one after the other?
Not necessarily in the market environment we've been in. This has been a very unsure environment. It's traded so much off of oil. Look at what you're doing. You're about in the center of the range, kind of a balancing day for oil. And it is unusual to get two balanced days like this, but certainly not unheard of. So I don't think I would let that. I just take each day as it comes along. Okay, let me in the wrap up. Let me talk about the last intensive that comes up starting April. As I said earlier, if you are going to join us for the last intensive, as soon as you sign up, you will begin getting the 2 daily reports, and I will do some chat comments throughout the day, providing I'm in town. For example, you won't get chat comments tomorrow because I'm going up to Washington State to fish for steelhead. Although I just looked at the weather report and it looks like rain and kind of cold, so that's not that exciting. But when I'm in town, and which is most of the time, you'll always get the 2 reports other than 1 or 2 days. You'll get some chat comments throughout the day. And what that does, it prepares you for the last intensive that starts early April. And all the reports we have had from this last intensive is people that know us have said this has been beyond anything they've seen before. We've gotten more involved, we've gotten more aggressive in the in the market with the chat comments, etc. So anyhow, we talk about market generated information. That's the basis of what we do. We say that we don't trade price, we trade value. Price is an advertising mechanism. And the biggest thing for people to become successful traders, in my opinion, is breaking this fixation on price and not really appreciating that price is no more than an advertising mechanism. Our commitment is we will give you everything we possibly can give you, and this will be the last intensive I do. I will be 76 this summer, and as my daughter, who does some of the writing for us, says, Dad's hanging up his trading hat for his fishing hat. So anyhow, I would really hope that you consider joining us, and all we can do is Julie and I will promise you that we will do our best to give you 100% of our effort. So once again, thank you very much and we look forward to those that are continuing on, as well as those that will be joining us for the final intensive. Thank you very much.
All right, great, Jim. Thank you very much. And thank you, everyone, for being here. This recording will be posted at jdaltontrading.com within an hour. Okay, and there's several other free recordings there for you as well if you want to learn more. And there's free articles as well there to read if you want to become more familiar with Jim's methodology. So thank you, everyone, very much. Thank you, Jim. And we'll be back. We'll be posting some more webinars in the month of March. So look for them in your email. And have a great rest of the day. Bye-bye.